in Phoenix. And so I've been at the firm coming up on 8 years. My career path is interesting. I started in 2006. I went to the University of Texas. In 2006, I came out and I started at a company called Lincoln Property Company. And Lincoln is a full-service, privately held commercial real estate firm. Lincoln does everything from property management to development, acquisitions to leasing. They cover all property types. I worked primarily in office at Lincoln, and my first job at Lincoln was as an analyst for the acquisitions group. I then moved into being an office leasing broker, which means that I represented office buildings in their leasing efforts. So my clients were groups like Stonelake that would acquire a building, and then I would help them lease it. And then after doing that for about 3 years, I moved over to the tenant rep brokerage at Lincoln, and that means I represented the tenants in the building. So I don't know how familiar all y'all are with real estate, but you know, whether it's an industrial building, a warehouse building, a shopping center, even apartments now, you've typically got somebody that represents the owner and somebody that represents the tenant on the brokerage side in a negotiation on a lease. And so that's what I did. Did that through the Great Recession. In 2010, I had just gotten married, and I was thinking about going back to business school when I met with a group called Trt Holdings. And Trt Holdings is the family office for the Rolling family. The Rollings own Omni Hotels is their primary investment. They also own an energy company. They also owned a gym company and other various investments. And I went over to work for them in 2010 as their director of real estate, which basically just meant that I handled all of their non-core, which meant non-hotel real estate investments. And so we built apartments, we owned apartments, we developed lots, we grew the gym business pretty significantly, and we developed gyms, we bought gyms, we bought gym companies. So there was some M&A activity, capital markets activity, development activity. Ultimately, I left the Rolling family in 2013 and joined Stonelake. And so I joined Stonelake as a vice president and in charge of acquisitions for North Texas. And I think it was about 4 years ago that I became a partner. There's 4 partners here. 2 of the founders, Kenneth Debussy and John Kiltz, and Travis Eichenhorst and myself. And so I haven't looked back. I've got 4 kids now, and we have 32 folks across the organization. We've grown significantly since I started, and it's been a fantastic journey, and I'm really excited about where our firm is and where it's headed. So that's me. Blake, why don't you tell them about your career path?
Yeah, so my name is Blake Wilson. I grew up in Mansfield, Texas. I went to school at Hardin-Simmons University in Abilene, small little Baptist school. And about the end of my freshman year, I had a couple professors that owned some real estate in Abilene. They asked me to come work for them, so I was basically a property manager at an apartment complex, just learning about leases, leasing, just real simple apartments. At the end of my sophomore year, I was looking for an internship. My mom at the time was a controller at Cook Children's in Fort Worth. It's a local hospital in Fort Worth. I met with the chief investment officer over there, and he ultimately introduced me to Stonelake. I met with Kenneth and Coleman back in 2016, and they offered me an internship. So summer of 2016, I interned in the Dallas office. I had 2 years of school left, but at the end of the summer, there was an opening for an analyst position, and Kenneth and Coleman told me if I can finish 2 years of school in 1 year, the job was mine. And so I went back, tested out of a lot of classes, took 20-hour semesters, and ultimately finished school so I could come be a part of Stonelake. And so summer of 2017, I started full time, and I've been going on 3.5 years now. I started as a analyst associate, and now my role is a director. So I'm responsible for kind of Dallas industrial asset management, leasing, property management, as well as Atlanta, which is a new market for us. I've been working on Atlanta for about a year now. So part of our internship program, I've kind of grown up at the firm, similar to some other guys, and really enjoyed commercial real estate so far.
Awesome.
Great.
Great interview, great introductions. And we did have, I think, one question pop up in the chat. And now the chat's gone for me, actually. Alman, can you go ahead and ask the question?
Yeah, so the question's from Michael, and it says, is Lincoln the same company that owns / manages the Village, etc. in Dallas?
Yes. Yeah. Same umbrella company. Hey, Michael. I work for Lincoln Property Company Commercial. That's Lincoln Property Company Residential. Lincoln's got a giant residential business and a giant commercial business. And so, yeah, it's the same owner, primarily, different side of the house. Blake's a great story, y'all, because and it really is we'll get to it later. I think it's topic 2, but Blake interned with us. Blake wasn't from Harvard. Blake wasn't from Penn or Wharton. UT Austin, or Blake was from a small school in Abilene. His mother was an accountant at Cook's Children. His dad works for UPS. Blake's is a super hard worker, and he got an opportunity to prove that. And that's really what we're looking for at Stonelake. And I would argue that that's what everybody should be looking for. I know that's what Herb Weitzman's looking for. I heard y'all talking about Herb earlier. Herb's a great guy, a good friend, and gotten to know Herb well over the years. And I think there's a lot of wisdom in the line of thought that you got to work really hard to get into a school like Harvard, and so that's fair enough. Harvard's a great school, but we're not looking for rocket scientists. We're looking for people that want to do something they love and work really hard to do it. And Blake was a great story where he interned with us as a sophomore, and then crammed 2 years of college into one to graduate after 3 years to come work for us. He's been promoted 3 times, and he's now responsible for a market for us outside of the state of Texas, our first market. And I'd say Blake's a great example to young folks who want to get in the real estate business. So.
Great, yeah.
So Gabby, Gabby, I've got this agenda. I'm happy to roll through it, or if you'd like to roll through it, you tell me what you'd like to do.
Yeah. We actually just want to go ahead and just get started with the questions, and then as questions pop up, I know JB Garza just asked a question. I think that'd be the best way to kind of go through it. Just talk a little bit about the topics, and then answer questions as they come through, and then we'll leave some time at the end for the case study.
Yeah, I don't know how to work the chat function. So I don't see questions. So how about we do this? I'll finish up the last 2 bullet points of the intros, and then we can take some questions, and then I'll go through topic 1, and then we can take some questions, and I'll go through some topic 2, and we can take some questions. Does that sound fair?
Yep, that sounds good. And we can monitor the chat, and as questions come up, we can ask them to you, and then get you guys to give some feedback on that.
Sure. Perfect. So most fulfilling part of the role and the most challenging, I mean, we've got 32 people at this organization, and I mean that's a lot of families, children, grandchildren, aunts, uncles. It's a lot of meals and schools and sporting events. So the most fulfilling part is to be part of a team that's providing not only great investment returns to our partners, but also providing a familial atmosphere to the people that work with us. To getting to know, we had our one of our construction guys, father had some stents put in his leg this week. And, so, just really getting to see the human element of what running an organization looks like. That's the most fulfilling part of my job. I mean, real estate's fantastic. Real estate's fulfilling because you get to go see what you're investing in. I mean, you're not buying a piece of paper that's traded on an exchange. You're investing capital into a real asset that's that you can go visit and touch and see. You can understand why people want to be there, why they don't. Its weaknesses, its strengths, its opportunities, and so the asset class is fantastic. And I think long term, our asset class is poised really to become one of the primary investment classes in the world. Traditionally, it's been a very small part of institutions' buckets, and I know that that's expanding. And I think that with a lot of the volatility in the world, it's going to become more and more of a safe haven, and that's going to be magnified by in the Texas markets and the markets in the Southeast that I mentioned that are going to continue to be beneficiaries of the net migration flow from, higher taxed, less friendly to business states on the West Coast and the Northeast. And so I'm really excited about it. The most challenging part about our role, about my job is, we've got 32 people in the organization, right? I mean, so, our company's not small anymore. And with that comes a lot of responsibility that doesn't show up on balance sheets and return summaries. And so learning how to be a great real estate investor and a great manager of people is very challenging and fun, though. And challenges should be fun. I mean, we're looking for folks that want to take on the challenges. The easy deals are the ones that everybody gravitates to, and the complicated deals are the ones that everybody kind of runs away from. Hey, it wasn't not my fault that Blake and I are working on a deal in Deep Ellum where we're trying to get an alley abandoned, and it's been a giant pain in the rear. And once we accomplish our goal there, we're going to add a lot of value to the property and a lot of value to our partners. And it's not been fun. It's been complicated, and there's a lot of easier things to work on. But we look for people that want to go work on the hard stuff and work on the challenging stuff. So Stonelake story simple. We were founded 13 years ago, around this month, 13 years ago. John and Kenneth Abusi started. John Kiltz and Kenneth Abusi started the firm. Their predecessor firm was a company in Austin called Cypress Real Estate Advisors, and so 13 years ago they started with a notepad and a Regis suite. They had 3 employees: John, Kenneth, and Travis, who were the three of the 4 partners. They had 2 desks and 3 people, and they rotated who got to sit at the desk that day. They had a whiteboard with ideas. This was in 2007. They had an incredible transaction that would take too long for me to explain, that ultimately blew up in the Great Recession. But in that, they had negotiated it was with a named institution. It was with Merrill Lynch, who's now owned by B of A. And but they negotiated a pretty, they kind of accidentally negotiated a pretty serious breakup fee. So when B of A broke up the partnership, before they ever invested $1, Kenneth and John got the capital in the breakup fee to kind of keep the lights on for 2 years, at which point we were able to raise our first fund, which was a 2009 vintage fund. We raised $35 million. Just to put it in an order of magnitude, 13 years later, we're raising our 6th fund, and it'll close at $500 million. So, really, 35 million was harder than the 500 million. And so, it really, getting started really is 75% of the work. And then if you stick true to your strategy and you put investment returns on the board, then you're going to continue to receive attention from capital providers, and that'll pave the way for, hopefully a long career in a company that lasts and stands the test of time. There's a lot of companies that get way over their skis. They try to raise too much money too fast. They have strategy diversion where, you know, one day they're doing industrial and now they're doing hotels, and all of a sudden the financial markets aren't cooperating and their company's toast. And you've seen that happen, you know, time and time again. And so being disciplined is really important. We preach that a lot at Stonelake, sticking to our strategy, having a disciplined approach to investing, being able to tell anybody that wants to hear what we do on one piece of paper and one elevator ride. It's simple, but it's important, because as soon as we start deviating from what we do, our investment returns are going to suffer and our capital is going to flee us. And so we live and breathe off of capital, and so we got to stick to our strategy to do that. So that's the Stonelake story in a nutshell. And I'm happy to answer any questions that I'm on that have popped up.
Yeah, so the next one is from JB Garza, and he asks, how do you think government-backed mortgages will play out over the next year in regards to defaults when moratoriums are lifted if the pandemic extends in the summer?
Yeah, what JB's referring to are these are I believe, JB, what you're referring to is Fannie and Freddie loans. They're typically housing loans. You know, listen, we don't subscribe to that kind of leverage. We probably have about $1 billion in assets right now. I'm sorry, in AUM, we probably got about $2.5 billion of actual, like, total book asset value. We don't have any government-backed debt on it. I'd say that you know, you're going to see, obviously, I think that play out in multifamily, in the Class C and Class B apartments. You know, I'd say that collections have been really strong to date. We haven't, you know, we own about 2,000 multifamily units, and our collections have been north of 99% each month. And so we're not seeing the kind of default that I think was a big fear early in the pandemic. We haven't seen that in our portfolios. So, you know, that said, you know, lenders have gotten, and government-backed lenders like Fannie Mae and Freddie Mac have gotten a lot more conservative in their underwriting of these assets since 2008-9. And so I'd say that lenders in general are well positioned. They've got a lot of equity in front of them. I guess a lot of equity behind them, and have been pretty diligent and conservative in their in their loan amounts and their loan to values and loan to cost. So I don't foresee a big wave of defaulted debt related to the pandemic in government backed in that specific asset class, multifamily. I mean, obviously, retail, hotels, office in certain areas of the country are going to suffer and have suffered tremendously. And I don't know that that's necessarily 100% pandemic related. I think that was a secular trend that was occurring prior to the pandemic, specifically with regards to retail. But I think that those asset classes, regardless of the types of leverage that they've used, are going to be in a lot of trouble over the next 18, 24 months and beyond.
All right, sounds good. I think that's all the questions I see right now. So I think we can go ahead and get started on topic one.
Sure. So I touched on real estate private equity earlier. You know, private equity just means you're investing in it's private investments. So you've got public investments. You can go buy Prologis, which is a publicly traded industrial warehouse owner. Great stock, by the way. I'm not a stock picker, and so I disclaimer, you know, don't make any investments based on anything you hear here today. But it's a fantastic company, one of the best operators of warehouses in the world, and warehouses are clearly the most in vogue asset class in the real estate business. There's the most capital chasing them. both from a debt and equity standpoint, and they're a great operator. So private equity, we raise equity and we invest in private deals. Public equities, that's your hedge funds, that's your stock pickers. So that's the difference just between public and private equity. And then real estate private equity obviously is just we invest in private real estate deals. So that's what we do. You know, private equity could be, to get to the next question. I mean, so we're in the fund management business. We've raised 6 funds, but then we've also raised 2 single asset investment vehicles, or single purpose entities, SPEs. And one is on an investment in Houston that I can flip through real quick at the end. And then the other one's an investment in Dallas, basically where we just raised capital. That these investments weren't really fits for our fund, either because of some kind of both of them were the same reason. They were both subject to ground leases at low yields that really didn't fit the return thresholds and the return timings of our funds. So we went, but they were phenomenal real estate investments long term. And so we went to some of our partners and went and bought these assets outside the fund in a single asset investment vehicle. So, which is what it says here, single purpose entity. So, so we primarily invest through funds. Blackstone primarily invests through funds. Trammell Crow or Lincoln Property Company, or Vornado, or pick your big developer shops, that they're going to be investing through these single purpose entities. And so they'll go find a deal, like right outside of my window. Trammell Crow Company just acquired Trulux in Uptown, located right there on McKinney Avenue, and I think that's Fairmont, maybe Maple. And they go and raise the equity for it. They go find a bank to provide the debt for the vertical construction, and then that's the partnership. And so they go and build that. They own it, they lease it, they sell it. That partnership is unwound. And so that's, whereas Stonelake, we raised $500 million fund, we go make 15 investments. All of those investments the performance of those investments are what's called crossed. So if we have one bad investment, then that could really pull down the performance of the fund. And so we take risk because we cross up all these investments. If Trammell Crow does 10 deals and 9 of them are great and 1 is terrible, well, they're going to make a ton of money, right? Because all of their deals are all crossed. If we have 10 deals and 9 go well and 1's terrible, then we're gonna work for free for 10 years. The benefit to the fund management business is we've got discretionary capital. So our investors make commitments to us. They're institutional investors. They're binding commitments. I just lost everybody. There we go. They are binding commitments. And so we have discretionary capital that we can go move quickly on opportunities that a Trammell Crow can't, because they don't have the capital lined up. And so there's other nuanced benefits to the fund management business. You generate fees related to the funds, and so you can have you have a recurring revenue stream. But those are the primary differences between a single asset investment vehicle and a fund. I've had experience with both. At Lincoln, obviously we were raising capital on deal by deal basis. At Stonelake, we're in the fund business. The benefits from the personal benefits I just laid out. At Lincoln, if you're batting 500, you're probably making a lot of money. Because your capital in each of those deals is relatively small. Call it 2.5 to 10% of the equity, and the equity is only 40% of the deal. And so if you get wiped out on 2 or 3 deals, but you make a lot of money on 4 or 5 deals, you're going to be okay. So The economics are better on a deal by deal basis for the single asset investment vehicles typically. But again, I mean, there's no recurring revenue. There's no kind of dependable income stream. And that's why all those companies have got into the property management and leasing business to try to generate some of that recurring revenue. And so the benefits to the fund business, like I said, I mean, we have a $150 million line of credit from JP Morgan that's secured by the full faith and credit of our LPs, and that allows us to go buy things all cash and close quick. And that's just something that the we call them promoters. They're great companies. They can't do that. So that's the difference. Stonelake's fund strategy is, it's we have four basic investment. We have four criteria to our investment. One is geographic focus. So we're focused on the markets that we're in. I mean, if somebody called me and said, "Hey, I got a heck of a deal in San Francisco," I'd say, "Hey, you might have the best deal in the world in San Francisco. I'm a pass because I don't know anything about San Francisco." Right. And same with Charlotte or Chicago or New York. We're very focused in the markets we invest. That's one of our strategies. Our second strategy is niche investment size. So, our equity checks are, call it $5 to $50 million. That's below a Blackstone or a Prologis or a Brookfield or a KKR or a TPG. But it's above a wealthy individual. Right. So, it's this niche investment size that we think is relatively inefficient, where we're slightly below giant institutions and we're above wealthy individuals. Three is a direct approach to investing. So something that's very unique about Stonelake is where we are the operators. We are the we act as developer. We are operator, which so that means it's our capital. We have no outside operating partners. That means that our partners have a level of control that maybe some other firms don't have. It also means that there's less layers of economics that are going out the door. And so, that we think that's really important. And then the fourth one is income with optionality. And when we get to the domain later, I can kind of walk you through what income with optionality means. But in the private equity business, we've got our investors are earning a rate of return when the dollars go out the door. So having cash flow to help pay that rate of return, it's called the preferred return or the pref, is really important. So we have a bias towards assets that can generate income or that do generate income. That's not to say we don't do a lot of development. We do, but you'll see we've got some unique ways to generate income throughout kind of the development cycle. So that's our four kind of pillars to our investment strategy. Our exit strategy is pretty simple. I mean, we want to exit to those big institutions. So if somebody told me tomorrow, or if we decided as an investment committee tomorrow that Blackstone was about to raise a fund where they bought a bunch of cows with purple polka dots painted on them, I would be in front of every farmer in Texas trying to buy cows, and I'd paint purple polka dots on them, and we'd go sell them to Blackstone. Blackstone doesn't want cows with polka dots. Blackstone wants warehouse buildings. Blackstone wants high-end multifamily buildings. Blackstone wants high-end office buildings. And Blackstone could be Blackstone. It could be KKR. It could be Arizona retirement system. It could be Ontario municipal employee retirement system, OMERS. It could be sovereign wealth funds. I had a call today with Kuwait Finance House, which is the financial arm of the second largest Kuwaiti bank. And guess what they want? They want warehouse buildings in Texas. And so, what we do in our industrial strategies, we've aggregated and assembled a portfolio of size and scale via $5 million transactions, but we've done that 100 times. And now, we've spent $500 million, call it $200 million in equity in a strategy that's worth several billion because Blackstone's not going to spend $5 million and Arizona's not going to spend $5 million and Ontario's not going to spend $5 million. But you know what they'll spend? They'll spend $500 million. And so we could spin out these portfolios at premiums to these giant institutions that want to be in the asset class, but they're so big that they have to write huge checks. And so our exit strategy, we see a lot of interesting deals, but if there's not an institutional exit, it's just really not a Stonelake deal. So that's our exit strategy. We invest in all the major Texas markets. We invest in Dallas, Austin, Houston. We buy industrial, and we invest in all asset classes in those three markets. We buy industrial warehouse buildings in San Antonio and El Paso. We buy industrial warehouse buildings in Atlanta, Nashville, Tampa, Orlando, and Phoenix. And then we're also looking for some development sites in Nashville and Atlanta. So those are the markets and the asset classes we invest in. And so, as I mentioned, and I would say 40% of our invested capital is in our warehouse assembly strategy, and 40% in infill urban multifamily development, and about 20% is in infill super high barrier to entry, class AA office. We don't do any retail. We don't do any seniors. We don't do any hotel. We don't do any niche medical storage. It's just not what we do. So that kind of takes us to the end of topic 1. Are there any questions?
Yeah, so there's one question by Anusha, and this is a pretty good segue into topic 2. But she asks, what is the best way to apply for internships and jobs at Stonelake? And would y'all be hiring across the various verticals?
Yeah, so thank you, Anisha. Let me see if I can find you. I don't see you on here. There you are.
Yes, I'm here.
But best way to apply is to send your resume to resumes@stonelake.com. We're actively accepting and actually interviewing summer 2021 candidates. We call it summer associates. We go through a very comprehensive, vetting program where it starts. And I believe I talked to Amlan about this, but it starts with like these giant resume books from all of the universities in Texas and a lot of our investors like Emory and Wake and Vandy and Richmond. All the Ivies, and we really just try to, so we sift through resumes, we look at the piece of paper, we try to come up with, some consistency to what we're looking at. Like we want you to make good grades. I think that shows that you're either smart or you're a really hard worker. And, I like to tell people that I'd rather hire a 3.3 student that makes a 3.6 than a 4.0 student that makes a 3.7. And so, we're looking for things like, obviously GPA is an easy one. We're not going to hire somebody that, slacks off in college. We're looking for kind of what are your activities? Have you worked through college? Did you work in high school? I'm looking for signs and tells of people that work hard, because I can teach you real estate. I can't teach you to work hard. That's just something that you either got or you don't. So we're actively accepting resumes. We got the UTA a resume book. I know that Blake and Jacob have been looking through it. Feel free to please send your resume to us, and that goes for all of y'all. And we'll if it passes the sniff test, then we'll schedule a Zoom. And then if you get through the Zoom, we'll invite you to our Super Day.
Awesome. Thank you very much.
Yeah. Are there any other questions online, or should I just keep going on topic 2?
No, that's it for now.
Okay, great. So, what should students who want to work in PE know about the PE field? I mean, listen, it's hard. It's intense. We're managing a lot of capital. It's precious. Capital is precious. You'll learn, as you move into your careers, just how important and how hard capital is. and so we treat it very seriously. We treat this as an opportunity. We've been charged. We've been blessed with an incredible opportunity. We're fiduciaries to some of the largest institutions in the country. They're relying on us to help generate a return so that they can cover their liabilities, whether that be free surgeries for kids at Cook's Children, or scholarships for Vanderbilt, or Memorial Sloan Kettering Cancer Center in New York, providing some of the most cutting edge cancer research in the world. And so we're fiduciaries to those investors, and we take it very, very seriously. So private equity, it's not a scary profession, but it's an intense profession, and it's not for the thin skinned or the faint of heart. So we're intense, and it's not for everybody. And we've had folks that have come work for us and it wasn't a fit, and we wished them the best, and we had to part ways. But we've also got stories like Blake Wilson that come as summer associates and get hired as an analyst and get promoted to associate and get promoted to director. And Blake's on his way to Blake is established as a very valuable team member, and is getting more and more responsibility. And with responsibility comes compensation. And so the other part of the paradigm is that the sky's the limit in our business. So you're not going to get you're not going to hit a ceiling. We want people that are blowing through ceilings. We got plenty to do. And so not for the thin skin, not for the faint of heart, but also perfect for somebody that's a self-starter, that is an incredibly hard worker, that can handle adversity, can handle success, that doesn't have to be told the same thing over and over and over again, that picks up on what we're looking for. Those people have the opportunity to be really, really successful. And so I think those are the two most important things to know about the private equity field. At Stonelake, there's no barriers to entry. I mean, we've got very limited space, just from a headcount standpoint. So, I mean, we're not going to hire a guy that, didn't graduate high school or something, so, I'd say the barriers to entry is get your degree that shows that you finish what you start, make great grades. That's up to you. I mean, that really is up to you. I mean, it's just how hard do you want to study? How hard do you want to work? Colleges can be challenging, but it's doable. And if you don't make great grades, be prepared to tell why, and I love hearing a story about somebody that, that has been on a steady upward trajectory, that maybe made a 2.5 their first year and decided they were never going to do that again. They made a 3.3 their next year. They made a 3.6 their next year, and they've got all A's right now. I mean, that's a great story. And so, I just say be prepared to tell your story, whatever it is. Have a story. Come up with a story. What's your story? And be able to tell it to somebody when they ask you, because you're going to be asked every single time you go into an interview room. But no, there's no barriers to entry that wouldn't be a barrier to entry at any other, investment firm, in the country, I would think. So we're not, like I said, there's some groups that only hire Ivy Leaguers. I mean, there's a lot of Ivy League kids that are in Ivy League schools because they're the fifth generation, and that's not what we're looking for. We're looking for hard workers. So no barriers to entry. Just be impressive. Yeah, there's a big learning curve. The question is, do you think there's a big learning curve to entry in PE? Yeah, there's a huge learning curve. There's going to be softwares and underwriting and models that you guys are either very limited familiarity with or none. There's going to be protocols and systems and expectations that are going to be communicated to you, but that you're not going to have any experience in, and that's okay. We have a young guy sitting out here, Jacob Becker, went to SMU, and Jacob might be on this call, I'm not sure, but and Blake was the same way from Hardin Simmons. Our expectation is not that you get real estate. in your first month or 6 months. Our expectation is not that you understand, how to install a roof on an industrial project, or what the proper protocols are for a lease up in a multifamily project, or what the appropriate level of debt is for an office construction loan, or any of that stuff. And we're going to teach you that, and we're going to expect that you learn it. But there's a curve, and it's a big one. But what we won't tolerate is lack of effort. And so again, you're going to hear, if you work at Stonelake this summer, or if you come to our Super Day, or anywhere in between, you're going to hear us preach that a lot. Effort, accountability, communication. Those are all things that anybody that wants to can do at a high level. And we'll teach you the real estate. And what does the resume of a recent hire look like? Well, so Jacob Becker is a recent hire. John Dedamore in Austin is a recent hire. Those two are our most recent hires on the investment team, I should say. Both those guys worked in high school, worked throughout college. Jacob had student debt that he's working diligently to pay down. Both were leaders. John Dedamore, we're not, this isn't a frat house over here, but he was the president of his local fraternity, and that shows leadership, and that shows accountability, and both had great value systems that we were able to kind of work through in some of our interviews. Both were very eager and hungry and punctual, and they presented well. You guys, there's just when you talk to a guy that's in his late 30s and up, we're looking at things like, did you shave before the interview? What kind of, are you wearing socks? What kind of shoes are you wearing? And we're looking for people that want to be there, and a lot, whether you intend it or not, your appearance gives the impression of whether you want to be there or not, and how serious you take it. I'd say that, bring a notepad, ask a lot of questions, take furious notes. I really don't care if you're doodling. I can't stand it when I have a young person come into my office and they just sit there, and I tell them all of this valuable information about our firm and about what we do and why we do it, and they don't take any notes. And I know that they don't know it, and it's a waste of time. So, when I was going through where I was in y'all's shoes interviewing, I had a yellow pad, and I took so many notes. And then I had a mentor, find a mentor. I had a mentor, and I would just, I'd be in the meeting nodding my head, and then I'd go call my mentor and say, hey, what the heck is a cap rate? What's triple net expenses? What's promote mean? What does pref mean? And so treat each of these interviews like an hour-long crash course in business, because you're getting this person's time. They're giving you a crash course in what they do, and that's an hour of valuable experience, because down the road you might go meet with somebody else, and now you've got an hour of experience, or 2 hours of experience, or 5 hours of experience. And I'd argue that I know y'all have some fantastic professors. You're going to learn more about the real estate private equity business sitting in a conference room with me and Blake for 30 minutes than you're going to get in a 3-hour semester class in college, just because we're not professors. We're doing it. Herb can teach you more in an hour than the professor. And I'm sorry if there's any professors on this call. I think y'all are fantastic, and I'm grateful for y'all's commitment to the trade. So that's what we value. I want to see things that show me that you work hard. Have I said that yet, Gabby? Okay. So that's kind of the career in private equity. Got any questions, Amon?
No, not yet.
Okay. I will. Blake, give me the screen.
Okay, 1 second.
How do I do that? Share screen? Yeah.
Yeah. Should be able to just click the green button and then just click on whatever screen you have opened to share.
Okay, hold on. Let me do this real fast. So we'll do domain. That's what y'all wanted to do. Make sure I've got the latest and greatest. Okay, let me go to share screen. Is it just like it? I still can't do it.
Let me come in there.
Host disabled participant screen sharing.
Yeah, I'm giving you host abilities right now. I think that I think it was Blake who had them earlier.
Here, just can you? Is it something you can do easily, Gabby? Yeah. Okay,
Yeah.
I got it. I
So
got
now
it. Great.
you're the host
Great.
now.
All right. All right. You guys see my screen?
Yep, we can see it.
Does it say domain south end up here?
Yeah,
Right.
yes it does.
So this is an investment we made in 2012 in the domain. So the domain is this massive mixed use development in North Austin. It's bound by Mopac, Breaker, and then over here is Burnett Road. You know, for those of y'all that aren't familiar with the domain, think Legacy in North Plano. You know, you've got massive corporate jobs. You've got, you know, Apple, Lululemon, you know, you've got a Neiman's and Tiffany's, and you've got high-end multifamily and high-end office. And so, you know, think Legacy, but way closer to the urban core of Austin. So we're 8 miles from downtown Austin, 8 miles north, versus, you know, 25 miles north of uptown, downtown in Dallas. So more infill, higher barriers to entry. I mean, you can see to the north, it's all built out with rooftops. There's more office to the north. Whereas when you get past Legacy, you kind of start to hit some farmland a little bit, right? So, so that's the investment. You know, the idea, the thesis was IBM used to own all of this. This was their original chip manufacturing facility. It's a 2.5 story, 482,000 square foot office building. We bought it at an 8 cap, which basically means that the rent that we were receiving was generated an 8 yield on cost. So if we paid $100 and they were giving us $8 in rent, that's what's called in the business 8 cap. But we knew their rent was way below market, and they had 1 5-year renewal option at market. So our bet was that IBM would renew. They had incredible infrastructure in this building, and if they renewed at market, it was going to be a much higher rent, and we were going to, you know, increase our NOI, net operating income on the building, you know, multiples. And that played out exactly like we thought. IBM ultimately renewed. Their rent went from $7.70 to $19.25 net, so nearly tripled. And it was a big win. But what was even bigger win, let me go back to the strategy, income with optionality. IBM was paying us income, they were paying us rent. And we had the optionality, we thought, to go develop these parking lots. And the way that we were able to do that was in their renewal, we agreed to build a parking garage. And that parking garage was 1,200 spaces for IBM and 1,200 spaces for this office building that we were going to develop. And in building this garage, it freed up all of the parking lots around IBM. Okay. So that's what it looked like. We built the garage, and then our first 2 phases were Domain Tower and Flatiron Domain. So there you can see the first 1,200 parking spaces. We had to get that built and CO'd so that IBM could park in it before we could start construction. And now you can see the second 1,200 spaces being built. And now that this is built, you can see this parking lot over here under construction, and this office building under construction. And so while we were under construction, we got an LOI from Amazon to take 2/3 of the building. We were negotiating a lease with Amazon. Then Indeed came around. For all of you that are searching for jobs, I'm sure you guys have used Indeed. It's the world's largest online job search platform. Indeed said, hey, we want 2/3 of the building. We said, hey, we've already got a tenant for 2/3. If you guys want to jump in the front of the line, you guys need to take the whole building. And they said, okay. So we ended up leasing this entire building to Indeed while we were under construction. We ended up selling this last year to iStar out of New York. They're a publicly traded REIT. That was an incredible investment for the fourth fund, generated incredible returns for our partners. You can come see now we've started construction on Flatiron. Flatiron is a 360 unit stick frame multifamily deal. You can see we call it Flatiron because it's got that Flatiron building corner. You know, it's a wrap, which means that you've got apartments that are wrapped around the garage as opposed to a tower or a podium where you've got them stacked on top. So you'll hear in multifamily development speak, you've got wraps and podiums and towers. This is a wrap. We also came and built a little boutique office building called Domain Place. We moved our offices in here and we've leased the rest of this. And we are under construction on Domain Tower 2 and the Bowen. You can see, I mentioned Legacy because, you know, Legacy's got JP Morgan, you know, Liberty Mutual, FedEx, Toyota, Fannie Mae. It's got, you know, it's a who's who of kind of corporate services, insurance, financial services kind of headquarters. Well, Domain is basically tech. I mean, you've got Expedia, Facebook, Amazon, IBM, Indeed, National Instruments, Apple, Schwab, IBM, all here in the Domain. And so these are the square footages they represent, which is enormous. So really kind of a tech, you know, corporate campus kind of vibe. So you can see that we're under construction on Domain Tower 2 in the Bowen. So again, the income was IBM. The optionality was all of these development sites in and around IBM. And so I'll show y'all some pictures. These are some renderings of Domain Tower 2. This is the site of Domain Tower 2. This is the Bowen. The Bowen is a 19-story residential tower. Domain Tower 2 is a 24-story office tower. These are some more renderings of Domain Tower 2 in the Bowen. This is the Bowen. It'll deliver next fall. These are some more progression pics. And again, we're self-performing on all of this development. We have no outside development partner. And then long-term, we've got plans that are already planned and permitted for Domain Tower 3 and Domain Tower 4. And then long-term, you know, this is the IBM site, right? I mean, that building doesn't want to be there long-term. And when it is gone, one day we'll have another 6 development sites right there in the donut. So a lot going on here. You know, in order to do this, we had to, you know, build a road. We had to move utilities. We had to get about 70 different easements from neighboring property owners and their lenders. We had to build a bridge that connected Burnett Road over the detention pond. Really a super involved deal, team effort. We own 100% of this, and it's an interesting Stonelake deal, income with optionality, kind of exemplified. So that's kind of the case study on Domain. And I think we're right there at the end of the time. I don't want to run over for you guys, so I'm happy to answer questions.
Yeah, thank you for sharing and kind of walking us through the plans and the kind of the optionalities that you had. That's very interesting. I don't think that many case studies that I've seen have had that before, but very interesting and definitely paid off for you guys in terms of future growth and just getting more, best use out of that land. So thank you for sharing that. And we are right over time, but I think if anyone has any questions, we can go ahead and ask that if they're kind of quickly, and then I can hang back for any other questions as well. Don't want to hold up Coleman or Blake any longer than we have, but if you have any questions at this time, I don't think I see any in the chat. Oh, there is one actually. Sorry.
I can see it now. From Rick when is it resume or resumes, Blake?
I think it's resume. Let me ask Jacob real
Hey,
quick.
Jacob. Is it resumes or resume at stonelake.com? We'll tell you in a second. Anybody else? Okay, let me get that answer. Can't believe it. Can't believe it's taking this long. Gabby, I'll email you, and you can email the rest of the group.
Yeah, definitely.
Sorry. I guess was that Rick? Yeah. Do you guys BRRRR? I don't know what that means, Jobin. Anybody know what that means?
Yeah, I don't know if
It's a real estate investing thing where you buy, rehab, rent, refinance, then repeat the process. Apparently, you can build equity very quick with it. I'm only learning about it, so.
No, it sounds like it's resumes. No, it sounds like a strategy where you go buy like a duplex, renovate it, rent it, refinance some equity out, go do it again, renovate it, rent it. Now you've got 4 units. Maybe go refinance all 4 of them, pull some equity out. That's not what we do. In the fund structure, we have kind of finite fund lives, and each fund's investments are they have a start and an end date. So, but I mean, listen, if you're interested in that kind of investment strategy, I mean, there's a lot of people that have built big businesses doing that. You got to go syndicate the equity and all that, but no, not a bad strategy. Just not what we do.
Yep, and I think that would be, I think someone else actually, Armando has a question. You mentioned the value of optionality in the IBM investment. Was there a real option pricing models involved in the valuation of the project?
Yeah, I mean, Armando, good question. The way there was a lot that had to happen in order for us to develop that land. We needed IBM to agree to let us build them a parking garage. They had the right to park in 1,200 spaces. We needed a forbearance agreement where they let us disturb the spaces to build the garage. There was a rezoning that occurred on the property that allowed for a lot more height. The zoning was okay before, but it allowed for a lot more height. I would say in our models, the way we thought about it was, we thought that our downside was if IBM left. If IBM did not renew, we felt like we had good downside protection in the dirt value alone. So, we really, our gut check was, well, if IBM leaves, what's the land worth? Well, the land was worth, we thought, more than what we were paying for it. Turns out it was worth a lot more than we were paying for it. But that was really kind of that was the binary situation that we kind of analyzed. Was if IBM renews, we know it's a home run, and then we can go negotiate ways to all this upside. If they don't renew, we own all this land because that office building's worthless to anybody else. And that was kind of the That was the two pricing models that we kind of worked through on that transaction.
Great. I think that was the last question. And
Excuse me, I have a question, if that's all right.
okay, yeah, go for it.
This is
Go ahead.
Carlos. I have a question about moving headquarters to your own building. Was that financially motivated or just kind of like live where we were?
No, we actually were gonna our lease was up at our existing building. We were gonna take space in the Indeed building before Indeed leased the entire building. So we kind of leased ourselves out of space. That plan actually called for 6 residential townhomes at the back of the property, at the back of that multifamily property that would be for lease. We were trying to find, 5,000-7,000 feet for our office in the domain, and there was nothing available because everything was leased to Amazon, Facebook, Indeed, Schwab, Expedia. And so we really thought there was this really neat niche opportunity to go build an office building that would lease and cater to smaller tenants that want to be in the domain, but there's no space in the domain. So, ultimately the economics also were much better, 6 townhomes at 1,200 feet or 2,000 feet, you're talking about 12,000 feet of leasable space. This was a 45,000 foot office building, and the yields have been fantastic. So no, Carlos, it was out of necessity. And then from that, we kind of we turned a couple lemons and some lemonade.
Thank you.
Okay.
Yep. Don't see any other questions. So I think this is a good way to good point to just wrap it up. And I want to say just thank you again to Coleman and to Blake for chatting with us today and giving us a little bit of insight into Stonelake Capital and private equity. I think you guys did a great job of kind of breaking it down and giving a lot of valuable advice. I know I did take some really good notes from this meeting. So I just want to go ahead and wrap it up, and we'll see you guys at the next meeting. And thank you again, Coleman.
Thank y'all. We look forward to meeting y'all if we can, and good luck. And real estate's a great business. So thank y'all for coming out tonight, and we'll talk soon.
Thank you.
Thank you.
See y'all.